Welcome to this weekly installment of the Whitaker-Myers Wealth Managers, What We Learned in the Markets This Week. My name is Summit Puri, and thank you for tuning in. This week, as usual, we'll discuss 4 key focus points, highlighting key learnings from the market activities in the past week. This week, since it's been a slow macro week, and there was an update in the COLA, or cost of living adjustment for Social Security, I want to spend some time sharing some thoughts on how retirees can navigate through the cost of living challenges. And as usual, in point number 1, we'll do a market recap with our key market indicators. In point number 2, we'll take a look at that Social Security COLA adjustment, which was 2.5%. In point number 3, we will take a look at withdrawal rates depending on market conditions. And in point number 4, we'll talk about longevity risk and life expectancy. Now, on to point number 1, the market recap. First, each week we review the Atlanta Fed seasonally adjusted GDP Now report to gauge in real time how fast our economy is growing. This week, the Atlanta Fed GDP Now report shows a healthy 3.3% growth as of October 25th, which is slightly down from the previous estimate of 3.4%. This data includes the recent releases from the U.S. Census Bureau and the National Association of Realtors. Next, each week we look at the initial claims for unemployment insurance for a gauge into the front end of the labor market. This week, the initial claims data showed a decrease of 6.2% from last week, ending at 227,000, while continuing claims rose to 1.897 million. Next, for 2024, we are watching mortgage rates closely to see how home affordability is trending. This week, we saw a slight uptick in the 30 and 15-year mortgage rates again, ending at 6.54% and 5.71%, respectively. Next, we'll take a look at investor sentiment. One component of investor sentiment is the measurement of the bull to bear spread. The latest update shows the bull to bear spread fell from 20.08% last week to 7.79% this week. As you can see on your screen, this is still higher than the 3-year average of negative 1.39%. Next, we'll continue to update you all on the Fed rate cut probabilities based on future contracts. Currently, the CME Fed Watch tool is pricing a 95.1% probability of a 0.5% decrease and a 4.9% probability of a 0.25% decrease in November. And finally, let's take a look at how the markets ended. Last week, the S&P 500, which is our proxy for growth and growth in income, but only when considered together, ended negative 0.78%. The Russell 2000, which tracks small and mid-sized companies or aggressive growth in our Dave Ramsey vernacular, was negative 1.41%. And the MSCI EVA, which tracks international stocks of developed countries across the globe, excluding the US, was negative 1.26%. Another team takes the lead this week, as the smallest loser, growth in income assets for the win. Well, remember, we watch these market and sector fluctuations weekly to show you in near real time not only how the markets are performing, but the importance of diversification. Nearly every week we have a new leader. Appropriate diversification decreases your risk while exposing you to the upside. If you'd like an unbiased review of your portfolio, don't hesitate to connect with one of our advisors today. For those in or approaching retirement age, there's nothing more important than building a portfolio that can support a long and fulfilling retirement. Given the difficult inflationary conditions over the past few years, the risk that worries most retirees continues to be outliving their savings. Until recently, the market and economic environment presented classic challenges to retirement planning, including high inflation rates and volatile financial markets. While stocks have rebounded to all-time highs and bond yields remain above historical averages, retirees may still be concerned about whether their portfolios will keep pace. Many of these concerns stem from the uncertainties such as the presidential election, federal rate cuts, market valuations, and more. While we can't control these events, we can control our own behavior. History shows that constructing and following a sound financial plan that can adjust in changing conditions, along with proper financial guidance, is still the best way to minimize retirement risk. How can retirees continue to maintain peace of mind and their quality of life in today's challenging environment? Well, we'll dig into that shortly. There's no bigger problem for retirement planning than inflation. Rising prices erode purchasing power of savings and make it more difficult to plan for the future. To account for the higher cost of goods and services, the government makes an annual adjustment. The Social Security Administration recently announced a 2.5% cost of living adjustment, or COLA, for 2025. This increase will benefit more than 72.5% million, excuse me, this increase will benefit more than 72.5 million Americans who receive both Social Security and supplemental security benefits from the government. While all adjustments are helpful, this 2.5% increase is lower than those in the past 3 years, including an 8.7% adjustment in 2022, the largest since 1981. These were in response to rapid price increases in the aftermath of the pandemic, amid supply chain disruptions, significant government stimulus, and the Fed monetary actions. The cost of living adjustments attempts to measure the effect of inflation on working class Americans based on the CPI-W index for households with clerical or wage occupations. The lower adjustment for 2025 reflects the fact that inflation has decelerated significantly since 2022. However, it's impossible for a one-size-fits-all policy to work for everyone, since every household has differing needs. This is especially true given the increasing costs of housing and healthcare. Thus, it is more important than ever for investors to maintain a portfolio that can support their needs throughout retirement, especially as life expectancies increase. For those who still have years or decades until retirement, this highlights the importance of savings and investing early to maintain purchasing power over long periods. Another aspect of maintaining purchasing power and quality of life is determining how much can be withdrawn from a portfolio in retirement. Perhaps the best known rule of thumb is the 4% rule. This concept was coined by William Benjamin, who observed that historically a 4% annual withdrawal rate from a portfolio was safe in that retirees were unlikely to exhaust their savings over a 30-year retirement horizon, accounting for inflation. For this reason, this is also sometimes referred to as the safe max rate. The accompanying chart shows the historical safe withdrawal rates based on the 60/40 stock and bond portfolios and inflation rates across a 30-year period, as well as the estimates for the most recent years. These illustrative figures show that only once in the 1960s did the maximum withdrawal rate fall below or fall as low as 4%. Of course, the safe withdrawal rate can vary dramatically from year to year, a fact that should not be surprising given how much market rates can change across a cycle. Now, all of this depends heavily on sticking to an investment plan throughout the full period. Investors who would have overreacted to short-term market pullbacks would have failed to rebound alongside the market, negatively impacting their withdrawal rates later in retirement. This analysis is also oversimplified since it does not account for differences in portfolio construction and risk tolerance across individuals that are critical part of real-life financial planning. For instance, a 60/40 portfolio may be quite aggressive for many retirees, especially later in life. However, what it does show is that despite the many market and economic challenges of the past several years, safe withdrawal rates are still quite strong. Not only did the stock market recover quickly after 2020 and 2022, but bonds have performed better more recently as well. Maintaining an appropriate asset allocation that can provide both growth and income is still critical for all savers, including retirees. What simple rules of thumb like the 4% rule also don't account for are increasing life expectancies. According to the Social Security Administration, 40-year-old men and women today have a life expectancy of 79 and 83, respectively, of course. And this is shown on the chart on your screen. However, the 90th percentile could live well into their 90s. Similarly, men and women who are 65 years old today could live to be 83 and 86 respectively on average, while the 90th percentile could live to be 94 and 97 respectively. The difference of a decade or longer, or a retirement of either 20 years or 30 years, can have dramatic implications for investment portfolios and financial plans. While the prevalence of longer, healthier lives is a fantastic development, it can present challenges from a financial perspective and is referred to as longevity risk. This risk is asymmetric in that running out of funds is far worse for most households than leaving money behind to loved ones, charities, and more. This means that life expectancy is an important input to any financial plan. Ultimately, managing longevity risk is another reason why all individuals can benefit from professional financial services. So, not only do retirees need portfolios that can generate income, but they continue to need growth to ensure that assets can maintain their quality of life over decades. The bottom line, inflation is slowing, but costs remain high. Retirees and those planning for retirement will need portfolios that can generate both income and growth. As life expectancies increase, having a portfolio that can support a long and fulfilling retirement becomes even more important. And that, friends, concludes our discussion for this week. Thank you once again for tuning in. If you find this information helpful and informative, please take a moment to hit that like button below. By hitting that like button, you help push our content out to other viewers and listeners across all of our social media outlets. If you'd like to see our latest videos on your feed, including new content released by our team, make sure to subscribe below. Also, if you'd like to meet with any of our financial coaches or advisors, please click on the link in the description below and schedule a meeting. Thank you once again for watching. We look forward to seeing you next week.